Good evening, everyone. Good evening, Ahmed. How are you today? Good. At least we're having 4 people. Let's wait for the others. We'll be starting 8:10. Once it's 8:10, we're starting. I hope we're all doing good. Imo, this is your first day here, and Samuel Kazim Akpa, I think this is also your first day. Good evening. Welcome. Apostle, you're welcome. For those who weren't here yesterday, we'll do a quick recap. As soon as we get, I think we're 5 now. Once it's 10, 8:10, we'll start it up. For those who weren't here yesterday, we did an introduction based on Forex trading and how we can become participants of the market. And I shared some slides on how to be a part of it, how to have your accounts ready and set, in which I gave an assignment as well. So we'll do a quick recap. Let's just wait for the others to join us. So we'll move along together. So we'll move along together. I know some of us are new to Forex trading, and some of us are a bit experienced, but not yet profitable. And some of us are willing to learn the ropes on how it's being done. Yes, in learning how to trade Forex, one very thing you want to adopt is hard work. Even after the class, you still need to make your own research. You still need to do some little bit of studies, practicalize things you've been taught, so it will stick to the head. Trading can be a bit difficult and can be easy. Can be difficult and can be easy because a lot of things are involved, and so also a lot of things are not important. A lot are not important. So as you go along with this trading, please endeavor to stick to it. Have your pen and paper by the side so that at the end of the day, you can still go back, revise, then get to master these things. For every topic you see us treating here for you, we are taking it step by step to mastery. We want to take you step by step to mastery. Every topic is a concept. You need to understand the concept individually. And then at the end of the day, you put all of them together and they become a whole. So they are like pieces packed together to form one full concept that will enable you to understand what to do, how to make money from the market, how to turn the Forex market into your ATM machine that you can print money from on daily basis, on weekly basis, on monthly basis, 6 months, 9 months, 12 months, depending on the type of trader you have decided to be. Let's wait for the others to join us. 8:10, and we're kicking off. 8:10. So yesterday I made some statement. I said we were going to make well, I was going to demonstrate how to use mobile devices. How to use our mobile devices. It could be your iPad, it could be your smartphones, Android, iPhone, whatever, iOS, whatever operating system. So we'll be doing that using the iPhone, Android. I'll switch to my screen when the time is up. So I'll switch over to my mobile phone. So you can see me. You can see me do that practically. You understand? So you can all see me do that practically. So let's just wait. It's 8:09 already. Once it's 10, we're kicking off. Now, my advice to you is this. If you want to take Forex seriously, you want to be so serious in making money from the Forex market, endeavor to have a laptop. Endeavor to have a laptop. Why the laptop? It makes your analysis easy. It makes your analysis easy. It makes you focus, you concentrate. Any little deviation in details could cost you money. Any little deviation in details will cost you money. So right about now, we're kicking off. Like you all know, for some who don't know, my name is Raphael Omoabugan. I'll be your host for this very period of 3 weeks of this training. And we want to, at the end of every day, or at the end of the training, get to produce profitable Forex traders, people who will bank on and say, yes, I think I can now make money from the Forex market comfortably. And the mentorship continues afterwards because it's still a long process in learning. The mentorship continues afterwards. So I will share my screen, my mobile phone with you, share my screen so we can all see how we use our mobile phone. Now, for those who weren't here yesterday, let me do a quick recap on what we did. I'll be sharing my screen right away for us to see. So, can you all see my screen? If you can see my screen, type yes in the comment section. If you can see my screen, type yes in the comment section. I believe you should be seeing my screen now. If you can see my slide, type yes in the comment section. Okay, okay. Omoyeni, you said no. How about now? You should be able to see my screen now. Okay, perfect. So yesterday we talked about, we did a quick introduction into the Forex trading, into what the Forex market is all about. And we talked about the importance of Forex and its significance to the financial world. We talked about the concept of currency pairs and how they are being traded and paired together against each other. And we talked about the major participants in the Forex market and their roles in the Forex industry. Now we came about basic terminologies that we all need to understand before we delve into the market. So we said Forex is what simply means foreign exchange. That's the exchange of two things for profit. Now, in terms of what are we changing? I said two things. We're changing currency. It's one currency trading against the other currency. It could be Naira against the dollar. It could be Naira against Okay, I am back. Sorry for that. I think my network is kind of acting strange this evening. So we talked about the basic terminologies. As I was saying, it is the exchange of currency pairs, the exchange of one currency against the other. And we gave an example of the Chinese coming into Nigeria to buy mineral ores like lead ore, tin and columbite, crude oil, and the rest of it. Now, And that alone is Forex in itself. Why? Because it involves the exchange of one currency for another. But
Please kindly hold on. I will get the co-hosts to come on board. Please kindly be patient. It will soon be back. Thank you. Hello, good evening, everyone. Good evening, good morning, good night, anywhere you are in any part of the world. I believe we are all here to learn. I hope you can all hear me. This is Olaitan from Dubai, and we are waiting for our trainer to come on board. As we all know, Nigeria is not a stable country. The internet is fluctuating. The meeting, I had a meeting this evening too. It was a terrible thing. So kindly be patient and wait. He will soon join us back, like he has said. I should give him a few seconds on the WhatsApp chat. So kindly hold on. He will join us back soon. Thank you.
Okay, I'm back. Can you all hear me? Can you hear
Yes,
me
we
now?
can hear you.
All
Can hear
right.
you. Bro.
So, as I was saying, now the Chinese company brings in their yen into the country, exchange for naira, go forth to the market and buy whatever they want to buy from the Nigerian mineral industry. That is still exchange. That is an exchange of currency for value. For value. Now they are getting the mineral ores and we are getting the what? The exchange value for the yen, adding to the Nigeria income, whatever. So that is just the basic idea. That is just the basic concept. But this time around, instead of us doing it traditionally and manually, hand-to-hand exchange, we're doing it via a platform. We're doing it electronically. You understand? It is the same concept you have with the abotis. When you go to borrow the change, you give them your dollar, they give you back in naira, the equivalent in naira at the value agreed upon. It is the same thing. But now we are not doing it manual, we're doing it electronically with an added advantage of participating in various markets around the world. When I mean various markets around the world, we have lots of currencies we can work on. If you're looking at one currency and that one is not working for you, or you're not seeing how you can get value from that currency, you can move to another. Try to look at it via what we'll be teaching you, which we call trading strategy. You go through it, you see if there's anything of value around it, you want to participate in that to grab what some monetary value out of it. So we talked about the three trading sections we have, which I made mention of: the London trading section, the New York trading section, and the Asia trading section. Yes, it is four, but I sometimes do take off one, which is the Australian trading section. Why? Because the New York trading section and the Asia trading section are just close to 3 hours difference. and the Australian section comes in the middle of the New York, the close of the New York section and the Asia section. Now, these sections in the Nigerian time comes around, for London section, it starts at 8 a.m. in the morning and ends around 5 in the evening. Now, there's a period of interlooping between the London section and the New York section. The New York section starts around 2 p.m. in the afternoon, sometimes 1, depending on GMT differences, sometimes 1. So from the period of that 1 o'clock where we have the New York section opening, the London section takes on that time. We call that period the interluding section, the interluding period, where the London and the New York comes together. And that is when we experience volume in the market. That is when we experience momentum the highest in the market. Why? Because the London people will be awake at that time. The New York people will be awake at that time. So many traders are participating in the market. Many business transactions are being done in the market at that time. So we made mention of participants in the Forex industry, in which I made mention of the government, the central banks, the hedge funds. We made mention of the hedge funds. We made mention of our local banks. We made mention of the retailers, which is the class we belong to, me and you. That's the class we belong to. And we made mention of the broker. An example is Do Prime, who is responsible for this training right now. So we talked about some basic terminologies in the Forex industry. We made mention of the pips, the leverage, the bid price, the ask price, the spread, the lot size, and the pipet. Now, I said the pips is what? The smallest, the measuring unit. The measuring unit for distance and price in the Forex industry, just the way you have meters for distance, like length, meter for length. For price value in the Forex industry, it is pips. If market moves from 0.5 value to 0.6 value, the difference between them is 0.1, and that is what we measure in pips. We measure it in pips. We now say 0.1 pips, 0.1 pips. I talked about leverage, the broker giving you an opportunity to trade in large sums, with your small amount of capital, your small depositing into the market. You've been given a high rate, a high power, that's high power to trade large funds, which becomes what is recorded at the back end of the broker. Then we talked about the bid price and the ask price. I said the bid price is that price at which the broker is ready to offer you that currency you're ready to buy or you're ready to transact in. And the ask price is that price the broker is ready to accept your offer for any price, any market you want to participate in. Then we made mention of the spread price, which I said the spread price is the difference between the ask price and the bid price. The subtracted difference between the ask price and the ask price. I talked of the lot sizes. Lot sizes is a portion, like already portioned amounts that you can buy. That is automated already. So we made mention of the type of lots we have. I talked about the standard lot size, the mini lot size, the micro lot size, and the nano lot sizes. Now, it all depends on the amount you have in your trading account, and that determines the lot size you will be using, which classes of lot size you will fall into. And we talked of the pipette, which I said it is the smallest value that makes up the pip. The smallest value that makes up the pip. It's just like say you have what can I make an example with? Let's say fractal. The fractal of a pip is the pipette. The fractal of a pip is the pipette. Then we talked about the trader's pack. Now, in this very trader's pack, we're talking about what tools you'll be needing to participate in the Forex market. And the major tools you will need is the MT4, MT4, MT5, the Trading View, C Ninja, and the rest of it. But what we're making use of in Do Prime is the MT4 and the MT5 platform, the MT4 and the MT5 platform. How can you get access to this platform? First, you need to sign up an account with Do Prime. You head over to their website, you sign up an account with Do Prime, you'll be given login access and password, investor's password, and a server. Then under there, you will see where download is being written. Under the download, you click on the download and you download the MT4 platform for whatever device you want to make use of. If it's a mobile phone, you will see MT4 for mobile. If it's a PC, you will see MT4 for PC. So you download and you install onto your phone. Now, I did a demonstration of the MT4 platform on the PC, and I promised to do the fast demonstration of the MT4 on the mobile for those who will be using the mobile. Then I gave an assignment regarding currency pairs merging, and I hope you guys had it done. For those who were here yesterday, did you try? Did you work on it? For those who were here yesterday, I hope you did something on it. So let's not waste much of our time. I'll head over to I'll be using my mobile phone now to log in. So I'll do a quick demonstration of what the MT4 looks like on the mobile phone, on your mobile device. Give me a second, please, and let's get over it. Okay. 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 Just few sec, please. Because I know if I'm logging in from my mobile, it might affect what you're seeing on the screen now.
Recording in progress.
So I'll be sharing my screen, my mobile screen with you. So please, if you can see it, you let me know. If you can see my screen, let me know. So can you all see my mobile screen now? Okay. So to download the MT4, all right, good. So to download the MT4 on your screen, first thing you need to do is head over to, for those who are using the Android, head over to your app store, the Google Play Store. Okay. Head over there. Click on it. Now I want to assume we already have an account. I want to assume we've gotten our account registered with DoPrime, be it the live or demo account. We head over to the search and we type MetaTrader 4. It comes up. Now, in place of the update you're seeing here, this update you're seeing here, for those who are downloading for the first time, you'll be seeing install. You will see install there. So you just click on install and it will take you straight up to your, it will get installed into your phone. So once it is done, it will bring up the option of open. So let's assume I've gotten mine already. All I need to do is to come to MT4, see it here, MetaTrader 4, but I shortened it for MT4. So anytime I say MT4, I meant MetaTrader 4. Then you click on it. And now it is loading. Okay. Now, for the very first timers, it won't come up with this screen. You won't see this chart and whatever you're seeing here right now. You will see something of this nature. Let me log this out. So, okay, you'll be seeing something like this. Do you understand? This is what you will see. And the next thing you do is you've gotten your username and password already. You've gotten your login ID, you've gotten your server. So all you need to do is to click on this plus button. Click on the plus button, and it will bring up this option. The next thing you do is click on log into existing accounts. You click on log into existing account, it will bring up something like this. Now, for those who haven't logged in before, all of this do fintech you're saying now won't be available. The only thing you'll be saying is this. This is what you'll be saying. The MetaQuotes demo. Now, this MetaQuote demo is not what you are to use. You are given a server. When you register, there's a detail of server sent to you. This is what it says. It says choose your trading server. So all you need to do is to type the server you were given. And our server in Do Prime is majorly this. Do FinTech Demo 5 if you have a demo account. If it's a live account, it will be Do FinTech Live 5, Live 2, Live 1, and so on and so forth. So depending on which one you were given. So let's say we're logging into a demo account. I'll click on the, let me even type that. Let me do FinTech. So you can see that brought up the list of servers. So if my server is a demo account, if I'm having a demo account, I'll click on demo 5. Then the login I was given, I'll choose, let me say this is my login here. So now I've typed in my login and password. All I need to click on the save password, then you click on sign in. Then you click on sign in and wait for it to now. Now, if you notice something here, it is saying connecting. Now it has connected and we logged in already. We've been logged in already. Now look at this. This part where you see this label, demo. Now you're seeing me have 2 accounts here. I can put as many accounts as I want. It's still the same process. Just click on the add button and do the same thing. It's just still the same. Now, if you have a specific, let's say you have 2 accounts and you want to trade on a specific account and you have them like this listed on your MT4 like this. What you need to do is click on whichever account. Just click on whatever account you want to log into. Let's say I want to log into the one with the $700 here. I want to log into that account. All I need to do is to click on it. Then the username and password is typed already. I'll click on sign in. And wait for it to log in here. It will be the first account on the list. Initially, we had a $1,000 account there. Now it's a 700. We're logged in already. So the next thing I need to do is to come over to, sorry. The next thing I need to do is to come over to where we have these 3 buttons at the top there, at the top right corner. I don't know why. Okay. Now, we just click on the 3 dots there at the top. Then I'll come over to trade. I'll come over to trade, click on trade, and it will bring this for you. Now, when it comes with this, these are there are shortcuts for coming right here. Let me clear this. As you can see, we have buttons below. We have buttons below. This one tells you, let me highlight it. This one tells you the very action you're in right now. It tells you if you're in a trade. As you can see, I'm in a trade now, and the market closed in the weekend. So this is a trade detail. $39 profits. Our balance is $700. That was what we had in the account initially. Equity is 379, which means the balance plus the floating profits. The balance plus floating 40 is 79. This is our free margin. This is our margin in percentage, margin level in percentage. And this is our margin itself based on your lot size. Based on your lot size. Now, you want to trade. You want to place trades. This is where you should head to. Click on that button. Click on the button. And as you can see, list of currency pairs. So let's say you've decided by your analysis, or you have a favorite pair you like trading. Let's say you want to trade Euro USD. This is Euro USD. All you need to do is just tap it. Tap on Euro USD. And you can see it has brought up the options of open charts, symbol properties, simple view mode. Now, if assuming the market was in action, we would have seen the new open order in the same format the others are. Now it's in gray color, it will be in white. So we'll click on open charts and we arrive here. We arrive here. Now, where are we heading to? I showed you something yesterday and I called it time frames. If you look at this chart, you will notice we have Euro USD at the top with something like H4. H4. That is the H4 time frame. H4 time frame. Clear? Now I want to do order for orders. All I need to do, if I want to visit the other time frames we have, I'll tap on the screen, one touch. I need to bring us this. Now you can decide to choose any of the time frames. We have 1 hour time frame, which is H1. We have M30, which is 30 minutes. We have 15 minutes time frame, which is M15. We have the M5, which is 5 minutes. And we have the M1, which is 1 minute. And we have MN, which is monthly. And we have W1, which is weekly. And we have the daily, which is denoted by D1. Now you want to add, we'll still come up to other things though. Like you want to add, you're seeing lines on the chart. You're seeing these lines. Let me delete these ones so you understand. Now you want to add horizontal lines, vertical lines, other special tools that we'll still talk about when we get to the part of indicators. You do the same tapping, tap on the screen, then you click on this icon that looks like shapes. This icon here. Click on it, and to come up with the various, it will come up with the shapes you can decide to choose. These are the various things we can put. So let's assume I want to put a horizontal line. All I need to do is to tap on the horizontal line, then come to where I want to place it. If I want to place it at the top here, I'll just tap on it. I need to place it there for me. Do you understand now? If I want to place another one, I do the same thing. Go there, tap on it again. Now let me put a vertical line. I'll tap on the vertical line icon. Go to where I want it to be. I just place it, click on it. So you can see we have vertical lines there. Now you want to place traits. Maybe you join our signal group, and a trade signal was being given on this currency pair, Euro USD. All you need to do is to click on this button and follow the instructions from the trading signal. Click on this, click on this button. So when you click on the button, it will bring up the option of, okay, because the market is not active, so it's not coming up. It's not coming up because the market is not active. But that is what you need to click on. You click on it, and it will bring up a dialog box. But we'll do more practicals on this when the market is active. Maybe on a Friday. Do that on Friday. I'll do a short video clip during market hours and send to the group so you all can watch and see how it's being done. So that is that for using the MT4 on your mobile phone. Let me switch over to my laptop so we can do what we have for today. Okay. So I'd like to know if please, I want to know if you understood what we just did on the mobile phone. Can you please type yes in the comment section? Type yes in the comment section, please. Okay, good. Thank you very much. So today we'll be doing fundamental analysis, understanding what fundamental analysis is all about. As the name implies, fundamental. We've got three major types of analysis. We have three major types of analysis. We'll do a little bit of typing here. We have the technical analysis. We have the fundamental analysis. And sentimental analysis. Now, the sentimental analysis and technical analysis work hand in hand. But it comes in when, especially the sentimental analysis, it comes in when you're already analyzing your trade. The fundamental analysis works along with them too. But why it is now taken differently is because some people are fundamental traders. I'll still talk about what fundamental is. There are fundamental traders. What does fundamental mean? Fundamental means news events that drives the market on a day-to-day basis. News events that drive the market on a day-to-day basis. And this news event determines the economy. It gives you statistical data about the economy of the country. It gives you the statistical data of the economy of a country at that particular time period, month, year, or whatever. So these fundamentals are taken seriously because they are reports that the market needs to see to understand the strength of a currency. If a currency is strengthened over the other or is weakened over the other. Let's take the Naira for example. Recently, the CBN increased they increased interest rates. And that spoke far into the international community who now felt, okay, I think we can now invest into the Nigerian economy. If we put in our $1, it's possible we could have 25% of our $1 within some certain period. That is on the economic fundamental aspect. And whoever sees that and understands how the economy works will want to put in their money into the Nigerian sector. And that is why you hear the federal government saying, investors are coming, investors are coming. Why? Because they are working on the interest rate to attract investors into the country. Now, that is fundamental for you. That is what fundamental does. Now, when we now say fundamental analysis, it is your ability to now look at a news event. Your ability to look at a news event and understand that, okay, if the statistics, okay, let me give an example. Interest rates. It is one of the economic drivers. Let's say interest rate was increased from 1.0 to 2.5. It means 1.0 to 2.5. Say last month, the interest rates for the Nigerian economy for whatever thing you're doing in Nigeria is 1.0. The CBN increased it to 2.5. Now, for those who were turned off by 1.0 and decided not to invest, because of the monitoring they've been doing, and they now saw that the CBN has increased it to 2.5, they'll be eager to put in money. Why? Because when they look at the potential of their returns and whatever money they're bringing into the economy, they feel they'll be making 2.5% of whatever they bring into the country. So it brings in investors. And when investors bring in their money, what does it do to the currency? It increases the strength of that currency. While it does increase the strength of the currency, it increases inflation. So a balancing is being done between those two things. And when inflation is being caused, deflation has to happen. Deflation has to be done by the central bank to balance the strength of the currency. And that is why you see one currency is weak today, tomorrow it is strong. One currency is weak today because these policies have to be done hands down. Like the CBN has to be ready for anything that is coming up. Decisions have to be taken right on seats to make sure these balances are being done and not to make one currency stronger for a long period of time or weaker for a long period of time. So I hope you guys understand this. I hope you understand this. Please type yes if you do. Please type yes if you do. Okay, good. So we have various I don't know, my screen is freezing. Okay, so in this very lesson of fundamental analysis, we're making it clear that this is the things you want you understand. How to apply fundamental analysis to your for how to apply fundamental to your daily analysis. The key components of fundamental analysis, the major economic events that affect the market. Yes, there are lots of fundamental analysis, fundamental events that happen on a daily basis, but some are important and some are not. Some are key drivers and some are not. Then you will learn a trading strategy on how to trade news, on how to trade a news event, and how to trade the news event. Now, the key components of fundamental analysis are divided into three. We have the economic indicator, monetary policies, and geopolitical events. We have the economic indicators, which is very important, monetary policies, and the geopolitical events. Now, let's head off to economic indicators. Let's head off to the economic indicators. Economic indicators are statistical data points or metrics that provide insight into the overall health and direction of an economy. Like I told you initially, interest rate was being increased from what it was before 1.0 to 2.5. People now investors saw the former data that it was 1.0 and it turned them off. When they saw 2.5, they got interested and they decided to say, okay, I think this currency is going to be strengthened and it's going to go bullish. It's going to go with full strength for the next 2 months or 6 months, that this interest rate will remain like this and they will come in with their money. So in that sense, the major classifications of events that drives this data are called economic indicators. And we have various indicators. The 4 major indicators we have are the GDP, gross domestic product. We have the GDP. We have inflation, interest rates, and the employment data. GDP, inflation, interest rates, and employment data. I will show us how to source for these news events so that you will be aware when it happens or comes that way. Please, for those saying the screen is too wide for their phone, you can turn your phone down, make it landscape. If you're having it portrait, make the phone landscape so you have a full view. Okay, now for GDP, gross domestic products. It is the measurement of all goods and services produced within an economy within a given period and is believed to be the best indicator of the overall health of a country. I will bring in a typical example. During the campaign season, we had Tinubu and Peter Obi. When Peter Obi was campaigning, all he was saying was, we need a producing economy. We need a producing economy for the Naira to be strengthened. We need a producing economy for the Naira to be strengthened. That was his key major point. We need to start producing. Now, this should give you a heads up on what he was trying to say. If goods and services are being produced in the country, and we start exporting these goods and services outside the country, it will bring in more money into the Nigerian economy. And when more money is brought into the Nigerian economy, it tells you that the economy is healthy, that the economy is strong. And when the economy is strong, it tells you the Naira is strong. and the naira can go in battle with any strong currency. So you as a forex trader who has the ability to understand this will know that, okay, since the naira is strong, all I need to do is to pair the naira with another currency that is weak, or a country that the economy is weak, and I'll make money from that move. Do you understand now? And I'll make money from that move. GDP on its own is not a particular useful indicator. However, the rate of change in GDP over a time can tell you a lot about the health of an economy. Now, let's say the data came out. Let's say we had the data that read, let me type this. Let's say we have something that says in the month of May, we have our data release. And in the month of May, GDP was 320. Let's say, okay, let me 320. In the month of April, GDP became 380. Now, when you look at this data, you get to find out that in the month of April, it increased. It tells you what has happened within that period of 1 month. There are more goods and services are being produced. And when more goods and services are being produced, it tells you the goods and services are in high demand. And when the goods and services are in high demand, more supplies are made. More supplies are made. The supply chain grows bigger, and the supply chain grows bigger means more money is coming into the economy. And when more money is coming into the economy, it gives what? It tells you the overall health of the economy is threatened. Do you understand that? More money into the economy, the currency of that country is being strengthened. Is being strengthened. So if we have a deficit, like we have a negative value between the old data and the new data, a negative value between the initial data and the final data, it tells you the economy is shrinking. It tells you the economy is shrinking. And when the economy is shrinking, it tells you the currency of that country is weak. At that particular time, it tells you the currency of that country is weak. Do you understand this? Please, if you do type yes. If you do type yes. If you do understand this, type yes. If you do understand this, type yes. Okay. Okay, thank you, thank you. So that shows we can move ahead. Now, inflation, the second key driver, inflation. News release on the level of CPI inflation reports on the fluctuation in the cost of goods and services over a period of time. Note that every economy has a level of what it considers healthy CPI inflation. Now, note something, please. When we head over to our source of fundamental events, you might not see this. You might not see it as inflation. What you'll be seeing is CPI, core products inflation, core price. You might see core price, you might see core products. It comes in any of the phases. Core price inflation or core products inflation. CPI. Sometimes it comes with index for product index. So you might see this. Now the CPI tells you that's the inflation. It measures the rate of inflation in a particular economy. Now, over a long period of time, as the economy grows, so should the amount of money in circulation, which is the definition of inflation. As the economy grows, so should the amount of money in circulation grow, which is the definition of inflation. Too much, I made mention of something, that the more money comes into a country, the more inflation you have. And that happened during, I think it happened during Buhari's time, during the tenure of Emefiele, when money was being printed. Money was printed into the economy, thereby giving rise for the cost of things. Products and services skyrocketed. Now, so many people might not want to believe that we had that inflation rate so high, so bad at that time. I think the inflation rate for Nigeria is at 3%, if I'm not mistaken. It's at 3%, which is very high. Cost of goods and services, everybody is complaining, is high. Now they feel too much money has been printed into the economy. Not as if we did transactions that brought in that too much money. No. It was the printing of the CBN that brought that, actually. So when you have too much money in the economy, the inflation rate increases. And when the inflation rate increases, it shows that it will bring about deficits. There will be deficit in supply and demand of goods over time. So the trick is for the government and central banks to balance themselves at that self-set level. So there's always a checkmate. There's always a balance that the federal government and the CBN, especially the CBN, will want to watch to say, okay, if we're beginning to see too much money in the economy, it means the cost of goods and services will increase, and this is not good for our economy. Why? Because the value of that currency will decrease. The value of that currency will decrease. Everybody will begin to have too much money in their hands. So that is where you begin to see bread goes for 1.5. You begin to see little things cost so much, because the common man believes everybody has money to buy this. So we want to what? Take that money from each other. So too much inflation tips the balance of supply and demand in favor of supply. And the currency depreciates because there is simply more of it than demanded. I already told you this. Now, the side of reversing that inflation is what we call deflation. And during deflation, the value of money increases. Why? Because we have little circulation of money into the economy. It's not like the economy is not healthy. It is healthy, but it is being regulated. The amount being pushed into the economy is being in circulation is being regulated. So goods and services becomes cheaper. Because of the scarcity of funds, people will want to sell their goods and services. People want to sell their goods and services at cheaper rates. But when money is everywhere, people want to sell it because they know you have the money to buy. So they call it at any price for you and you just buy. You understand? So in the short run, it may be a positive thing, but for the economy in the long run, it is a negative thing. Money is fuel for the economy. Less fuel equals less movement. So at some point, deflation will have to deflate. There's no how, because if it gets too much, the money loses its value. So there's a part of check and balance, check and balance, check and balance. That is why we have this central bank monitoring team. They're always looking at what the Naira is doing. So they'll know how to go back, go forth, go back, go forth to balance that move. To balance the move. Now we have the part of interest rate. This is one big one in fundamental, very big one. The interest rate is one major economic driver, even the biggest so far, the biggest economic driver. Why? Because it sets the tone for the economy for a period of 3 months, 6 months, 1 year, depending on the central bank's decisions and the economic team of that country. How does it set it? Every country wants investors into their lands. People want the dollar to come into their lands. Nigeria wants the euro to come into their lands. Nigeria wants the yen, the Chinese, to bring their money into the country. And how do you get the attention of these big investors? You get their attention by increasing your interest rates, by increasing your rates of interest. So an interest rate is a percentage of the principal amount of a loan or deposit that is charged or paid by the financial institution over a specific period of time. In the context of Forex, interest rate can affect the value of currency. For example, if one country has a higher interest rate than the other, its currency becomes attractive. I already told you this. Its currency becomes attractive to investors, causing its value to increase. Once that interest rate is high, investors will come. They will come into the country. They will bring in that money. Conversely, if one country has a lower interest rate than the other, its currency may become less attractive, causing its value to decrease. Let me tell you one secret today. Those who trade fundamentals majorly, who are just basic fundamental traders, what they do is they monitor interest rates. They monitor interest rates, and get to understand that at a particular time of maybe 2 weeks, let's use the US dollar and the euro, for example. US dollar, we want to do something practical here. US dollar and the euro, for example. If the dollar has high interest rate of say 2.5 for the month of say for the month of January, and the euro has its own for 1.5, the dollar is stronger than the euro, right? Which means we should see the currency pair Euro USD selling. We should see the currency pair Euro USD selling. Okay, I said I wanted to say something yesterday, but I forgot. Thank God we're doing this now. When you see a currency pair like this, let me give this. If you see something like this, Euro USD, the pair that is the strongest will be, the currency that is the strongest will be the driving force in that currency pair, will be the driving force in that currency pair. If the euro, if this one is stronger, you will see the market going up. It will be pushing up. You will see the market going up. It will be going up. If the dollar is the strongest, you see it coming down. If the dollar is the strongest, you see it coming down. The market will be dropping. We'll do practical examples on the charts for you to know how the market moves, up and down movement of the market. You see it coming down. So most times when you hear the term Euro USD is bullish, it means it is going up. Going up. When you hear Euro USD is bearish, it means it is going down. Do you understand now? And when you hear Euro USD is ranging, it means the market is fluctuating with no specific direction. Fluctuating with no market direction. It's neutral. We can use the term neutral. We can use the term consolidation. It says consolidating. So you might come across some analysis that will use any of this term. That's just the meaning. If Euro USD is bearish, it means it is going down, and that tells you that the US dollar is stronger. If Euro USD is bullish, it means it is going up and the euro is stronger. Do we understand this? Do we understand this? Are you guys with me? Okay. If this is a quick one, it is a quick one, I needed to chip it in, so I shouldn't go on. If you find, if an analysis says Euro USD, which is a currency pair, Euro USD, which is a currency pair, is bullish. Omoyeni, please. Is bullish. It means the market is going up. And it means, also means Euro is the driving force. Which tells you that Euro is strong, stronger than the dollar. If we have it dropping, Euro USD is bearish. It means the market is going down at that time. It means the US dollar is stronger at that time. Now, this can happen for a period of 1 week, 1 month, 2 years, 1 year, depending on the interest rate differentials between the two currency pair. So I was making an example. Let's say the US dollar has an interest rate of 2.5% and the euro has an interest rate of 1.5%. The US dollar has shown strength with its 2.5% interest rate. This would push the euro US dollar to sell. So what fundamental traders do is this: they try to monitor interest rates, go over to the charts, and wait to see that downward move in the market. Immediately they get to see this downward move in the market. Now, what I am trying to tell you now is how to apply fundamentals to technical analysis. How to apply fundamentals to your daily analysis. We'll talk about technical analysis in our next class. What fundamental understand is just have this at the tip of your head so that when we enter there, you just you get the understanding real fast. So what they do is they already know that the dollar is stronger than the euro. So all they need to let me show you an example. Let me pull up my chart. So we could use that as we have something here. Okay, Euro USD. Now, can you all see my charts? If you can see my chart, please type yes. Can you all see my charts? Please, we don't have time. Okay, good.
Yes.
Good. Okay. So now we already make our assumption that the Euro USD, as fundamental traders, the Euro USD is selling based on the interest rate for the month of maybe say May. Now I'll come to my charts. Where's my pen? This is how the market moves. So as you can see, the market moves in zigzag pattern. They don't walk straight. Okay. The Forex market moves like this. If it's going up, the zigzag pattern. And if it's coming down, it does the same thing. The zigzag pattern. We'll talk about trends and market structure when we get to technical analysis. But just enjoy this one as it goes. So what they do is this: they'll now wait, already knowing that the Euro USD is selling. They'll wait for that zigzag pattern of Euro USD to happen. Now, this is what we have. We have up, we have down, we have up again. As you can see, it's a zigzag pattern, and we have down. Now, what they do is they'll wait for the market to go up again, knowing fully well that it should continue with the down. Then they join around here and follow the market to somewhere downwards. Some will take their profits at this level. We'll just end it here, and some will allow it to keep going, depending on your profit appetite. Some will take it to here, and some will end it here. So do you understand this now? Do you understand this? Do you? Okay, good. So that's the part for interest rates. Now, the way interest rate impact the forex market is through change in expectation of interest rates that leads to a change in demand for the currency. If the interest rate is high, the demand for the currency will be high. If the interest rate is low, the demand for the currency will be low. That's just the way it works. Then we'll head over to employment news. This is another big one for fundamentals employment news. The employment data comes up referring to the numbers of jobs, numbers of people that are jobless, the rate at which the government employed at a particular month, in a particular year. It comes up every month. I'll show you the time frames, the period at which you can see these data and how to interpret them. So the employment rates data refers to statistics related to the employment rate, job openings, and labor force participation in a particular country. So in Forex, what we do is this: the employment data may be used to assess the economic health of a country and its ability to support foreign exchange trading. So some key indicators of employment data may include the unemployment rates. Is the unemployment rate higher than last month or lower than what they have for last month? If it's higher for last month, is going to be, if it's higher for last month, is going to, if it's higher for last month, higher than what we have this month, it tells you that the economy is not doing well. If the rates, the percentage of the labor force that is actively seeking employment is higher than who they have employed so far, it tells you the economy is not doing well, like what we have in Nigeria right now. The rate of unemployment is higher than the rate of employment, and you can tell what the economy is all about right now. So that's just the way it is. Now, investors and traders are willing to have these informations, getting to understand that it will have high labor rates in the market, labor force in the market. That tells you, okay, now let's use this logic. High labor force in the market can affect the gross domestic products positively. Yes or no? Please drop your answer in the comment box and let's see what you drop your answers in the comment section. Let's see. The labor force of the markets, the labor force of a particular country can affect GDP of that country. Yes or no? Yes or no? Yes, 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 yes. And yes, in the sense that the more people we employ in the manufacturing sector, the more goods are being produced in that sector, the more money is being made. So you can see how related all these things are. You can see how related they are. If you have less people working, it tells you what? That the manufacturing sector or the employment sector is down. And that tells you there can't be more money in the country. Money can't come into the country. Do you understand that now? And now as an investor, when you check all of this data and you're seeing this, you're seeing what the employment rate is telling you, you're seeing unemployment is higher than employment, you won't feel safe to bring in your money into that kind of country. Thereby, you will not be safe to trade the currency of that country. Now, for us traders, what we do is this. We pick a currency pair that has a high unemployment rate when the data is being released. We pair it up with another currency that has high employment rate. I will put them together. I will trade in the right direction. In the right direction decided by the currency with a high employment rates. So it is now you understand the pairing of these things now. You understand the pairing of these things. So let us go quickly to how we can see source for these informations. How we can source for these informations. There are two websites you can make use of. The first one I normally use is, I call it Forex Factory, forexfactory.com. The second one is investing.com. And there's another one again, myfsbook.com. So we'll be doing, let's do for the three of them. Let's do for the three of them. I'll start with Forex Factory. I'll start with Forex Factory. Let me clear this. I'll start with Forex Factory. Okay. So this is a page for Forex Factory. Now, it is not a must that you can join. If you want to join, good. But if you don't want to, still good. This is the interface of Forex Factory. You come over to calendar. You come to calendar here for you to see the events for that day, that week. Just click on calendar. And these are what we should be having May 28, May 29, 30, 31. So let's see what we'll be having next week. Okay. Starting off on Sunday, these are what we should be expecting. These are the news, the events we should be expecting. The events we should be expecting. All of this you're saying now, all of this here. All this one in the middle, down to the end. Down till the end, as you can see. I told you about unemployment, right? You can see unemployment here. You can see employment change. I told you about CPI. Okay, add this to your box. We'll still talk about the fundamentals we have regarding some certain currencies that are very important. Construction, PMIs, BOC rate statements. Now, for this BOC, it is the same thing as interest rate for Canada with the Canadian dollar. We have the ADP. So we'll talk about specific events and their names. So what is peculiar to one currency? Okay, we're looking at next week. Now for next week, all day, this is the time, as you can see. These are the days and their dates. These are the days and their dates. These are the time. These are the currencies it will affect. And these are the rate of the rate of impact you'll be having. Now, in this rate of impact, if you have your pen, write this down, please. The rate of impact, you see the ones in the red folder. These are the powerful ones. We call them high impact news. We call them high impact news. Those are the ones you should be concerned about. Those are the ones you should be willing to trade. High impact news. The one in the orange folder or the gold folder, we call them the medium impact news. The medium impact news, while the ones in gray color, the ones in gray are the low impact news. The ones in gray, sorry, non-economic, sorry. The ones in gray are non-economic. The ones in gray are non-economic. Then there's one in yellow. Let's find the yellow folder. Okay, there's no yellow folder here. Okay, that's because I selected, let me open that. That's because I selected, okay, apply filters. Now, you will see some in yellow. See that? These are low impacts. These are just normal things they will release and it won't really affect the market. It will never show anything about the market. That's why they call them low. So the ones you should be concerned about is the ones in red and the ones in a good color. These ones in red, these ones in good color. Anyone you see in gray tells you the market might be silent for that day. The market might not really move. Volatility will be low for that day. As you can see, bank holidays. So if the bank will have a bank holiday in the US, you should expecting the dollar to act neutral. Bank holidays, GBP should be affected because that means there will be bank holidays in London. So it means the British pound should be affected. You might not really see strength coming out from the British pound. So major news events, red folder, and the gold folder. Now let's talk about how you can analyze them. Now looking at this, I want something we've done, something in the past that has been released. Okay, let me head over back to, let me take this out so we can. Okay, look at this one now. This news here, this one. The currency to be affected is the USD. Mind you, this will not be printed out yet until the time of release. This is the time when the news will be released, which is 3 p.m. 3 p.m. Nigerian time. This is when the news will be released. When you open this site for the first time, your time won't be correct. You'll be seeing an American time. So all you need to do is to come over here and convert to Nigerian time. Put the GMT. Just click on it. Click on it and to tell you GMT +1 West Africa. And you save. So that's that for that. Now it has given us news in Nigerian time. Now, before the release of this news, you won't see anything here. It will be blank. It will be as blank as this. It will be blank like this. There'll be nothing here. That's the way this one is. That's all you'll be seeing here. There'll be nothing there. The only data you'll be seeing is the forecast. The forecast and the previous data. That's what you'll be saying. The forecast and the previous data. Now, this forecast is the data released by, what do we call these houses now? You know, there are houses that will sit, financial houses, yes. There are some financial houses that will try to understudy the economy and bring up their own indexes, what they feel should be the result of that economy at that time. So the market will be looking at this compared to what we have previously, what the central bank in the US released previously. So all we need to do is to look at what they'll be coming up with. And as you can see, this is higher than this. Now, to understand this news very well, like to understand the strength, all you need to do is click in here. Click inside this folder. Just click on this folder here. Let's click and you will see. Now, look at this impact, usual effects. Actual greater than forecast is good for the currency. Actual greater than forecast is good for the currency. So what's the actual? The actual is 102 and the forecast is 96. So that means the market was looking at the 96, but when the owner of their data released their data, we had 102. And this tells you that the dollar should what? Show some strength. The dollar should show some strength, short-term strength for that day. The dollar should show short-term strength for that day. So now, if you're trading euro dollar for that day, all you need to do is to put this at the back of your mind that anything from 3 p.m. Nigerian time, you should be expecting a little strength from the dollar to come into play. Expecting a little strength from the dollar to come into play. Let's pick another one. I'll take this one. Let me take unemployment claims. Unemployment claims here. Now, we have the forecast to be 218 and the actual came up to 19. Now, do the same thing I showed you. Do the same thing I showed you. Click on the folder there. Go to usual effects. Here, actual less than forecast is good for the currency. Actual less than forecast. Now, when you look at the actual is higher and the forecast is lower. So which tells you what? That the US dollar will be weak. Why? Because the actual is higher than the forecast. So for that day, around that period, that time of 1:30, the New York section, we should be expecting a bullish move. Anything that is trading against the US dollar should be strong. Anything trading against the US dollar should be strong, should be buying. Trading against the US dollar should be buying. I think we have something happened on that day. Let me check the chart on Thursday. Can you see my chart? Let's look for Thursday. Thursday, this is Friday, and this is Thursday. So you can see what happened on Thursday. This is the opening of Thursday, and this is the end of Thursday. This is the end of Thursday. So look at what happened. The market bought from here. The market went up because dollar was weak. The market kept going up and ended that day here. Had the highest there, so you can see it bought, and that strength kept on going for the next day, which is on Friday. It did the same thing too on Friday and ended here. So can you see how we can apply this now to our chart? So anytime you're doing your analysis and you figure out these things at their time, take note of them and wait for the events to happen. Now, for those of us who feel, okay, but this news is going to take a while before we get to, let's quickly do something on the remaining portals. Now, this is investing.com. You just go to investing.com. Then head over to economic calendar. See it here. Head over to economic calendar. Economic calendar. Click on it. And to bring you to the calendars for the day. And that is what we're having here. These are the calendars for the day. So all you need to do is look at the currency of interest. If you're trading the USD, look at what the USD will have for that day to their time. Now, the importance is this. As you can see, we have stars here. This one is showing their own in stars. 2-star, 3-star, 2-star. So the ones in 1-star are not really important. The ones in 2 stars are medium impact news, like I told you from Forex Factory. Then we have the one for high impact news. Let's see if we have anyone on high impact news. High impact news. Okay, I think for next week, we don't have anything on high impact news. For next week, we don't have anything on high impact news. Let's see. Yesterday's, okay, Friday. Let's go back to yesterday and see what we have. If there was anything high impact. Yes, I think we found one. For the Euro CPI, as you can see, is a 3-star. A 3-star. That is, if you're using this one, 3-star is high impact. 3-star is high impact. Another one, 3-star high impact. Another one, 3-star high impact. So this is Forex investing.com and Forex Factory. How to use these news events. How to use these news events added to your day-to-day analysis. Now we have a strategy to trade the news. Should in case you want to be a fundamental trader, like it is just the news you're interested in trading. This straddle strategy is simply saying, whichever direction the market is headed to, I should take part in it. If the market is going up, let's say before the news, this is what the market is doing. Before the news release, and let's say the news will be released around 1:30 Nigerian time. You want to be a part of the news. Now you don't know what direction, because you don't even know what the data result will be. What will they release? You don't care about the release. All you know is you want to be a part of the move. Now, straddle strategy is saying, if the market goes up, I'll be a part of it. If it goes down, I'll be a part of it. How would you do this? Now, let me head over to the chart so we can execute something there practically. This strategy is being executed on the 5-minute chart. You go to the 5 minutes time frame to have it done, please. The 5 minutes time frame. Patience, please. I don't know what's wrong. Okay. The 5 minutes time frame. So here we are on the 5 minutes. This is our 5 minutes time frame. So let's use this example, this part here. Let's use this part as an example. Let's use this part as an example. Because anytime before a news event, the market goes with a consolidation. It ranges. It doesn't go up or down. It just stays within. And see the consolidation here. You would see it's not going high. It's not going lower. It's just between the middle. It's not like this. This is trending. This is consolidating. This is trending now. This is trending. You understand? There was a consolidation before the trend. There's another consolidation before the trend move. But this is trending here, a ranging market in between. So let's say before a news event happens, you will experience something like this. You might experience something of this. So let's assume we're expecting maybe unemployment data to come out, and we don't know if it will be positive or negative, good for dollar or not. But whichever we want to be part of it. Now, these lines you're looking at, these horizontal lines you're looking at, this horizontal line here, that's our ask and bid price. That is where price is currently on the chart. That's where price is currently on the chart, and that is shown here. That is what we have here. Current price. So all you need to do is place a sell stop here, place a buy stop here. On the highest part of that consolidation, on the immediate lowest part of the consolidation, place a sell stop here, place a buy stop here. Then for the sell stop, you put your stop loss 10 pips below your entry. 10 pips below your entry. 10 pips below your sell stop. So even if the market goes around against you, you're only losing 10 pips. Here you put for your buy stop. Oh, sorry. Okay, this is for 10 pips for your buy stop. Let's say this is where your buy stop is. You're expecting the market to go. That if it goes in this way, you should be a part of it. But if it's wrong, it might just come down here, hit you, and you're away from it. So you might not really lose much. So here should be your stop loss for your buy stop. Here should be your sell stop. And your stop loss for your sell stop should be the same 10 pips as well. 10 pips. When you place them, your profit level should be 20 pips times 2 of your stop loss. 20 pips times 2 of your stop loss. So if the market goes up in your favor to buy, it will take you out at 20 pips in profit. If it comes down, activate you from where it is right now, from here, comes down, activate you for a sell, it should go straight to give you 20 pips. But if it comes down, activate you for a sell, then eventually goes back up, it will take you out here in 10 pips, activate your buy, and might eventually give you back your profit. So which means you break even. You will break even, you didn't lose anything on the account, even after hitting your stop loss. Did you get that? Did we get that? Did we all get that? Please, if you do, signify. No, good. Okay, confusing. Okay. Who again? All right. Let me quickly do this. I wish we have a live market to work with. Now, do you know what a buy stop and a sell stop is? Let's even start from there. Do you know what the buy stop and the sell stop is? If you guys should answer, we don't have time. No, that is why it is confusing. You don't know what the buy stop is and what the sell stop is. A buy stop is a type of order. Okay, I now understand why. A buy stop is a type of order where you are saying, let's say I place my buy stop here. What I am trying to say is this, that if the market comes to this level and take me in, this is my buy stop, that I should keep going up and predict the market to activate me or take me into the buying order from here. The kind of trade you place is a buy stop. For a sell stop, maybe you're looking at this level. Say if the market comes down, eventually comes down to this level, I believe it will continue selling. So I'm putting my sell stop here. And once the market gets there, cross over it, it will trigger you and it might start selling. Do you understand what buy stop and sell stop now means? Are you guys with me? Do you understand what sell stop and buy stop now means? Good. So most times you might put your buy stop here, maybe after your analysis. It's not buy start, it's buy stop, not buy start. At the time's confusing you. That is why I told you something earlier, that after whatever class we hold, go back and make your research, do your research so you can learn more. You don't expect me to teach you everything here. It's not possible. In how many hours? You know how many years knowledge I'm dispersing to you in less than how many hours here? So this is what you do. If you're having a buy stop signal, a buy stop, you place a buy stop is that order you place at a particular price level, believing the market will come to that level to trigger you in and continue in the direction of the buys, in the direction of the buy going up. If it's the sell, it is that order you placed, predicting the market should come down, cross over, and trigger you to start selling, to start going down. You start selling to start going down. Start going down. So now, in the case of our straddle strategy, if you want to trade the news from where price is right now, from the current place where price is now, price is here. This is where price is now. This is the current price state. We're counting 10 pips from that place, from here. We'll put 10 pips. Let's say our 10 pips is here. This is where we'll put our buy stop. 10 pips. Our buy stop will be 10 pips here. Now, from that place where the market is, from the buy stop, you want to put a stop loss. Stop loss is that instruction you're telling the market that if you get to this level and you're not going in my direction, take me out at this price level. I am comfortable in losing so amounts. I am comfortable in losing so amounts. Yes, it's small, it's a pending order. It's not like it's more in a pending order. It's a pending order. Buy stop, sell limit, buy limit are all pending orders. They're all pending orders, but we're being specific with buy and sell stop for trading this strategy. Buy and sell stop. So when you already have your buy stop here, telling the market that from this level, I expect you to go up. Once it comes in, you trigger me in and you move ahead. We do the same thing for the sell stop. From where price is, we put in 10 pips. Let's assume the 10 pips is here. Sorry. Let's assume the 10 pips is here. All we're telling the market is from here, if you drop down, take me in and sell. If you drop down, take me in and sell. Now, you already have the sell stop here. And mind you, whenever you're selling, your stop loss is always above your entry price. And whenever you're buying, your stop loss is always below your entry price. So we already have our sell stop here. Definitely our stop loss should be above somewhere here for sell orders. Now, in calculating your stop loss should be 10 pips from where you have your stop order. All you do is just to calculate 10 pips and you place it. So let's assume this is 10 pips from here. From here to here is 10 pips for sell order. That is for sell stop. Now for our buy stop, from here to here, let's assume it's another 10 pips. So now when the news is being released at that time of 3 o'clock, we don't know the direction. The market will just start moving anyhow, but just start moving, and the next thing you see, huge spike. The next thing you see is huge spike in any of the directions. Huge spike in any of the directions. And it will what trigger you in any of the others. Most times, when the two currencies you're pairing with for your news events both have data release at the same time, which happens normally with USD and the Canadian dollar. That is when you see, instead of one directional movement, you see something like this. It will go up, come down, go up, come down, go up. So if you place this kind of trade on using this strategy, it's possible you might lose that trade. Why? Because the market will just, it will be going up and down. It will take you, it might trigger you for both buy stop and sell stop, thereby rendering your account in a huge loss. So what you should be looking out for is one currency pair that has news, just one that has news at a particular time, and pair it with another that doesn't have. Then you apply this strategy to it. You apply this strategy to it. I hope you understood this. How profitable, how is profit made if the strategy results in break even? If it results in break even, there's no profit made. If it results in break even, that's the meaning of break even. There's no profit made. That means you didn't lose. When I mean result in break even, coming down to trigger you in for a sell, then it will now turn around again to want to go trigger you for a buy. It will definitely go in one direction at the end of the day. It will definitely go in one direction. So it might be the buy direction. It just came in to trigger you for the sell, then it will continue in the buy direction. And if it takes you in the buy direction, because you have a 20 pip stop loss and a 20 pip take profit and a 10 pip stop loss. So at the end of the day, you balanced the trade. Your profit has covered you from the 10 pip loss you took in during the sell. Do you understand? Do you understand now? But if the market goes in one direction alone, it will take you in for your 20 pips profit. It will take you in for 20 pips profit. Good. So I want to believe we all understood this. Good. Thank you. So now, what are the risks in trading involved in trading the news? Market volatility. At that time, you begin to see certain injections of market movements. You begin to see volatile moves in the market. So if you want to trade that, you need to understand that during that time of news, there are volatilities. Volatilities will be coming into the market. So you're ready for that kind of momentum move. You're ready psychologically, you're ready, you want to take that. You begin to see whipsaw, like I told you. You begin to see whipsaws, moves like this, just go come down, move. You're ready for all of that. Psychologically, you're ready. If you're the type is being scared, maybe you see one move now, hey, wait, you won't cut the trade. You cut the trade, and the next thing you start seeing it going in your direction. You blame yourself for that one. Now, the misinterpretation of news, that one happens a lot. The inability of knowing when one news is positive or negative for that particular currency. Your inability. That is why during that hour, you need to go and see what the effect is, thereby relating the actual to the forecast. Relating the actual to the forecast. So that gives you a head of what the actual effect of the news will be on that currency. Now we have overtrading. Overtrading during news trading is a very big thing because you're seeing it move in one direction. You want to enter multiple times. You'll be tempted to enter multiple times because you think it will continue. Now the market might just be moving up, and maybe you were scared of entering, you were scared of using the straddle strategy, and you just saw it going up. You want to enter. If you enter for a buy, you might see it turn out immediately to come for a sell. And because you see going for a sell, you cut your buy trade and you enter for the sell. Immediately you see it selling again, the next thing it turns again. It turns back up. You cut the sell, you went and enter for the buy. So news trading comes up with this kind of temptation if you're not being disciplined. And that is one way of blowing your account. Then we have information overload. Too much information regarding what the market will do. Now, your inability to digest and to justify those information will cause confusion in the market. So you won't be able to trade accordingly and according to the way you're supposed to do. Now we have geopolitical uncertainty. It is possible that a news will come out and it will be positive for that currency. But some events might just come up, some natural disasters might just come up that will unturn that news event, the effect of that news event. Say you saw CPI to be positive for US dollar. God forbid, then maybe there was an earthquake just happened. You will not expect that into the CPI effects to take charge again. So you might just begin to see something like, instead of one directional movement, you just see something doing like this. So there's no way you can trade such movements. You understand this now? Do we all get this? So I want to believe we've come to the end of today's class, and we all understood, at least we all understood what we did today. Please, let's try and revise what we've done. Please, let's revise what we've done. It is easy to forget if you don't practicalize. Very easy to forget if you don't practicalize. I want to hand over the platform now to Mr. Ola. Hello, sir.
I'm with you. Well done.
Hey.
This is just a kind of brief information for everyone that is on the webinar. If you have not opened your live account, kindly chat me up on the phone number I dropped yesterday so that you'll be able to open your live account, because you will need your live account as we are going on in this training, because it is very, very important for you to have your live account. So tomorrow is day 3. Make sure you are available on time. Prepare your notes, do some other research, because what has been delivered onto you is just an insight for you, but it is now left for you as a trader to make research on your own. Because if we are to share our experience with you, we share so many years experience. So you cannot just, it cannot happen overnight. You have to train yourself. You have to make sure you are ready for this. Like I do tell some traders, most especially newbies, I do tell them that you have to obtain PhD.
I think his network just went off. So we can't hear you. I think his network just went off. So let me try to conclude what he was trying to say. Guys, you will need more research, please. You will need more research, and we are always open to answer your questions, whatever you don't understand. We're open to answer your questions. Okay, I think it's back. It's back.
Sorry, the internet is just fluctuating since morning. Sorry about that. I am very, very sorry. So like I said, you need to have that 3 qualities before you can be a good trader. You have to be patient, hardworking, and disciplined. So I will be telling you more about these three letters as we are going on. So see you tomorrow in our module 3. Have a wonderful night. Bye.
Good night, everyone. We'll see tomorrow. Regarding the
do you have anything to say, any one of you, so that I can unmute you all? Let's do that before we leave. So
some were asking about the recordings, if they can get the recording.
yes, I've answered him. I said
Okay.
it will be available.
Okay.
To be available. Okay.
All right, sir.
So your mic is available for you now if you want to say anything.
All right. Please, guys, we already said this, and he has said it all already. Let's try and put in more effort in our learning process, please. It makes the job easier for us training you as well. It shouldn't be that we'll come to the class and we'll begin to say every. It takes a long time to learn all of these things. So we want to cut the journey short. You play your part, we play our part, and we'll meet at the very balance. All we need to now start doing is giving your experiences and how to help you navigate all the shortcomings you might be having or finding. You understand? So help us, let's help you better. We want to appreciate you guys for coming on. I guess tomorrow is another day and we'll meet tomorrow. So I wish everyone a wonderful night rest. Let's all sleep right. God bless us all.
Okay, good night.
Good night.